Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the U.S. government has shut down for the first time in 7 years. Republicans and Democrats failed to reach an agreement on a spending deal, and neither side is backing down. Republicans are pushing for an unconditional short-term funding extension to keep the government open as they hash out their differences. Democratic leaders are framing the fight as a clash over health care coverage. Their main demand for the funding package, the inclusion of health care provisions absent from the GOP proposal. That includes an extension of Affordable Care Act subsidies that expire at year's end and a reversal of Medicaid cuts enacted earlier this year. Turning to the market impact, stock futures and the dollar falling as traders monitor the risks associated with the shutdown. Meanwhile, gold continuing on its record-breaking rally with the precious metal nearing $3,900 an ounce. One risk for investors lies in the potential for an economic data blackout. Weekly jobless claims and the September payrolls report will be on pause if the government shutdown continues, and that poses risks to the Fed's rate-cutting cycle. While the next Federal Reserve meeting is still 4 weeks away, policymakers might have to make their decision without the government jobs data or the next consumer inflation report. That's due October 15th. They'll have to rely on private employment data, beginning with ADP's report this morning. That showed an unexpected 32,000 decline in jobs last month after a revised drop of 3,000 in August. Let's get a check in on stock futures right now. Given all of that, we are seeing some weakness here this morning, although the tale of what happens during stock markets during government shutdowns is usually not one where there's extended declines. There's a little trepidation here. This shutdown could be a little bit different if some of these job furloughs turn into cuts. So we'll be piecing through what all of that means, also all of those implications for economic data. Right now, we've got indications for a lower open across the board. So let's dig more into this top story of the day. The federal government shutdown officially in effect after lawmakers failed to reach a funding deal. Futures tumbling as investors weigh the implications for the economy. Joining me now, Washington correspondent Ben Worskell and senior markets reporter Ines Ferré. Ben, let's start with you. Give us the latest state of play.
Yeah, so the latest state of play is kind of a standoff state of play. We're firmly in the kind of denial, anger, name-calling phase of this without either side even pretending that they're talking to each other. Trump's latest commentary is about amping up the political pain from this shutdown as much as he possibly can. The response from Democrats is to say, as Chuck Schumer said just about an hour ago, they're not going to be bullied on this. So they're not even pretending to talk, and that's definitely not even happening behind the scenes. What that leads to is sort of the idea, a growing sense here in Washington, is that a short shutdown scenario is dependent on one side basically conceding completely to the other. We saw that's the closest thing to bipartisanship we've seen in the last 24 hours, which is a Senate vote last night, which failed, but did see three members of the Democratic caucus cross party lines to vote yes. This was the unconditional, we're going to extend the government for 7 weeks bill that you mentioned at the top of the show. So that number is a key one, and there's going to be another vote today. So there's going to be a lot of attention on whether this 3 number rises. Senate Majority Leader John Thune would need 8 Democrats in total to join him. So it's a lot more Democrats would have to cross the party lines to succeed there. But that's the kind of way this ends on the short term. The Democratic case on the other side is that this could be a longer shutdown and and then the mounting costs here could force Donald Trump and Republicans to the table. They're thinking, I would characterize it this morning as essentially the mounting economic costs, potential market impacts, as well as voter anger over health care could force Republicans to come to the table and create a kind of compromise bill that would keep the government open, but include some of these Democratic priorities. And
what are some of those economic knock-on effects that we need to be watching for, Ben?
Mm-hmm. Yeah, so these effects kind of come in waves. It's all a question of duration. A longer shutdown equals more effects. There's been about 21 government shutdowns in recent years. The only ones that really matter are the ones that last a week or more. The most recent one lasted 35 days and took about $3 billion out of the U.S. economy is the estimate there. The first effect will be economic data. You mentioned this at the top, but Friday's jobs report will not come out, assuming that if this shutdown continues. That it's important to note the data is already there. It's sitting there. There's just literally no one in the office to finish the final preparations and send it out. These effects will increase including inflation data, if this proceeds, and could impact the underlying data gathering that the markets rely on so much from the U.S. government. The economic effects similarly will grow over time. The big X factor here is whether Donald Trump will go forward with his plans to reshape the government using increased shutdown powers that he does now enjoy. He's talked about mass firings. He's talked about cutting programs. We're already seeing lawsuits saying he can't do that. He's misinterpreting the law. But how far he goes there is clearly going to have sort of a chaotic effect on the federal workforce that could quickly ripple into the larger economy, depending on the specifics of what he's going to try there.
And then speaking of the president's economic agenda, right, he obviously is pro-growth. The shutdown is not that, right? So how does he sort of thread that needle and preserve his growth agenda at a time when the government is shut down?
For sure. One of the interesting aspects of all these contingency plans, these are kind of dry government documents that they release, is how much the Trump administration is focused on keeping their other aspects of their economic policy going forward. Tariff investigations is a big one. That will continue according to the Commerce Department's plan. These are the investigations that have to go for a certain period of time and then produce a report before Trump can implement new tariffs. Those are going to keep going so he can kind of keep on that timeline, especially as he moves towards more sector-specific tariffs. We're seeing new tariffs that actually went into effect today and coming in the coming weeks. So that's a big aspect. Another one that's getting some attention this morning is the plan for a bailout in Argentina. The Treasury Department's contingency plan keeps that in effect, so that could continue. So he's trying to kind of keep all these other aspects of his agenda going, as well as these kind of plans for restructuring the federal government, which will have economic effects as well. So he's, as you mentioned, he's really trying to kind of keep all systems go on that front in spite of this shutdown drag on the economy.
Okay, so Ines, given all of that we've just discussed, talk me through what we're seeing in the markets this morning, because we have been saying usually we don't see stocks really affected by a shutdown, but we are seeing a little bit of jitters this morning.
Yeah, we're seeing a little bit in pre-market. You are seeing the major averages that are down slightly, but keep in mind that you had the S&P 500 and the NASDAQ clocking their best third quarter since 2020. You also had the Dow actually at a record high yesterday. So nevertheless, we are seeing this slight dip. And if we take a look at our Wi-Fi Interactive, you can see in pre-market, you can see some of the sectors that are under pressure, like, for example, communication services, financials are under pressure, tech are under pressure. And then over on the NASDAQ 100, we're seeing some of the bigger names. NVIDIA, which has been at all-time highs, is down less than 1%, Microsoft. So these are some moves that we're seeing in equities. Not a whole lot of movement in equities, but we are seeing a weaker dollar. We are also seeing yields that have been falling. So we're taking a look at the 10-year Treasury. That's at 4.1%. We're also looking at the U.S. dollar index that's at 97.6. And then also, of course, we've been watching gold, which has been surging to new highs. So gold is around 3,900 per ounce, almost at 3,900. These are gold futures. And gold year to date is up 50%. One interesting note, or nearly 50%, an interesting note from Bloomberg, actually, that we've seen in this big rally in gold this year, we've seen little drawdowns. The biggest drawdown was barely 3%. So this is interesting because similar to what we've seen with equities, that we haven't seen big drawdowns with equities, with gold, you haven't seen that much of big drawdowns. So this makes it look like on the surface, this is a very sort of solid rally. And you do have central banks that have been buying quite a bit, but this is very one-sided, crowded trade. So if the dollar were to go higher quickly, then you could see a bit of a pullback in gold.
And Ines, also, we keep talking about how we might not be getting government economic data for a little while, and therefore we're paying more attention to some of the private data points. We got one of those this morning from ADP, and it wasn't very encouraging.
No, it wasn't, that data came in lower than expected with jobs shrinking. Look, this has been, in fact, the reason why you saw the yields coming down is because of that ADP report. And since that report, you have the Fed watch now investors expecting 99% probability that the Fed is going to cut in October. Because if there was any doubt that, well, the Fed's dual mandate, are they going to cut or not because of the slowdown in the labor market, yet you're still seeing inflation that's higher than what they would like it to be. Well, we're seeing now with this ADP data, which is the one that we have, we'll see if what happens with the jobs data and delays there. But nevertheless, this is indicating that investors now are expecting a cut. Something interesting in the ADP data, too, that came out was that the small and medium-sized businesses are bearing the brunt of this, of the slowdown that you're seeing in this jobs data. So perhaps that K-shaped economy that we talk about when it comes to consumers, we also are seeing this when it comes to companies as well, that the smaller and medium-sized are suffering more than the bigger size. I will note, though, that you still have Wall Street that is bullish on this stock market rally that we've seen. You still have targets that are seeing the S&P 500 going higher. And you just saw commentary recently from Goldman basically saying that the biggest risk to the economy is a slowdown in the labor market. But if the economy can sort of get through this slowdown, then the market can look towards next year for these Fed cuts that are coming, and also as far as the fiscal stimulus, the whole big beautiful bill and all the impacts of that is going to be boosting companies. Again, on the larger side, when it comes to that fiscal stimulus, some strategists say, but nevertheless, Wall Street's still bullish despite the slowdown that we're seeing in the labor market.
Yes, for now. Ben, Ines, thank you very much. Appreciate it. With many uncertainties around the government shutdown, here's how it could affect your finances. When it comes to your portfolio, investor sentiment may be jarred in the short term, particularly if the shutdown affects the Fed's rate-lowering agenda. That could mean potential volatility in financial markets, but historically, shutdowns have not resulted in a major sell-off. Now, turning to the economy, the impact will depend on the length of the shutdown. Federal employees won't get paid until the government reopens. If the shutdown stretches for weeks or months, the D.C. metropolitan area could be hit particularly hard, as it is home to hundreds of thousands of federal employees. But the impact will not be limited to D.C., Maryland, and Virginia. Federal workers are, in fact, spread across the country with large numbers in states like California, Texas, Florida, and Georgia. The Congressional Budget Office estimates that about 750,000 employees will be furloughed at a cost per day of $400 million in lost compensation. The Trump administration's plan to fire some federal workers outright could also drive jobless claims higher at a time when employment already looks fragile. Essential services will continue through a shutdown. That includes military, law enforcement, the Postal Service, the FAA, and the TSA. During past shutdowns, some TSA checkpoints were closed and travelers faced longer lines when agents didn't show up for shifts. As far as benefits, federal Medicare and Medicaid health insurance programs, they're considered mandatory spending. That means benefits will not be affected. Social Security will also continue to be distributed, but staffing in some services could be affected and cause slowdowns. And as for SNAP benefits, they'll only be affected if the shutdown lasts for more than 30 days. That's because funding typically only allows the Agricultural Department to send out the benefits for 30 days after a shutdown begins. Well, coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Nike, Occidental, and Lithium Americas. First up, Nike topping first quarter earnings estimates as its turnaround plan starts to pay off. Shares are higher after the company posted surprise sales growth, but executives did warn that progress, quote, won't be linear. The company is also getting hit by tariffs. It's now expecting them to cost Nike $1.5 billion and hit gross margins by 1.2 percentage points in the current fiscal year, which is 2026 for them. Next up, we got Occidental Petroleum. According to the Wall Street Journal, Warren Buffett's Berkshire Hathaway is in talks to buy Oxy's petrochemical business for around $10 billion. That deal would be Berkshire's largest since 2022, and Berkshire's already the largest shareholder of Occidental, which has a market value overall of around $46 billion. Finally, Lithium Americas rising as the U.S. government agrees to take a stake in the company. This making official what had been reported upon recently. The Department of Energy plans to take a 5% equity stake in Lithium Americas and a separate 5% stake directly in the company's Nevada mining project. The plan marks the Trump administration's latest effort to speed development of a domestic supply chain to counter China's dominance over minerals and metals critical to defense, automaking, and consumer electronics. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, markets are looking to open lower this morning amid concerns surrounding the government shutdown. It comes at the start of the fourth quarter. That's typically a strong period for stocks, with research from Bespoke Investment Group finding that the S&P 500 has ended in the green 74% of the time in the fourth quarter. What effect will the shutdown have on all of that? Joining us now, Mark Malek, Siebert Financial CIO. Mark, good to see you.
Great to be here. Thanks.
So, shutdown. What are we thinking about the shutdown? Because as we've been saying, usually the market does okay through a shutdown. This morning, things are down. It seems like this shutdown is causing a little, there are always jitters at the beginning, but this one seems a little unique also.
Yeah, listen, you can't ignore the market backdrop, right? As Ines and you covered just before, look, the markets are at pretty much all-time highs. Tension is high. We have earnings just around the corner. So, it's not so bad that the market is sort of reacting this way. But, historically, again, if we look at these shutdowns, looking at the last 10 of them, markets tend to fare pretty well, even if they last longer. Now, of course, the last one, which was the longest, that had some interesting events around it, right? You had the market already tanking. You had the Fed raising rates.
This was in December of 2018.
2018.
Right.
You had already the Fed raising rates and then last minute shifting. So that kind of affected how the market reacted. But ultimately, even if you look 6 months out after all of these have ended, we see generally positive results. So you can't ignore that. But there are some differences here too, like the furloughs and things like that.
Right. If they end up making the furloughs firings,
Yeah.
Does that change the equation? Is that enough? I mean, we already have concerns about the job market. ADP this morning was pretty lousy.
Yeah. Well, it definitely it will have impacts on the economic numbers. Whether it phases the market, that's a whole other question.
Yeah.
I think we got a lot of shock and awe earlier this year with Doge and layoffs and things like that. So the market may be a little bit sort of hardened to that reality. But these numbers, you cannot ignore these numbers. And we have to see how they're going to play out and how the Fed is going to respond to that. I mean, clearly the markets are now factoring in more aggressive Fed rate cutting. That should put some downward pressure on yields. But government shutdown should put upward pressure on longer yields, right? Which a lot of people aren't talking about yet. I haven't seen that happen quite yet.
So we've been talking about what this all means for the Fed and the market for not having certain economic reports, right? We're not going to have the jobs report on Friday likely. If this lasts longer, CPI's due for October 14th, I believe. But around mid-October, we also start to get earnings. So the market presumably will then just be taking its cues from that.
Correct. I mean, that'll be the ultimate arbiter, as it should be, right? We're gonna, we start with the financials, and the financials will hopefully tell an interesting story because they had some great beats last quarter. I think markets are starting to hope for the best, like the whisper numbers are a lot higher than the published numbers, but that could be the real telltale about how the rest of the earnings season goes. We have maybe 2 weeks before we start getting those numbers, and I think that's really gonna sort of set the pace.
Are you changing strategy at all right now? Is there any area where you're shifting sort of weighting in various sectors?
Yes. Well, we like the financials for all the reasons that you would like financials right now, and the yield curve and the expected moves in the yield curve, et cetera, the deal flow, all of that is there. But they are a little rich. And it's very hard to, sometimes you have to just pinch your nose and say, this makes sense. And it has worked. That strategy has worked. So we're always nosing around looking for opportunities in finance and financials. And there are some out there with maybe private credit and things like that. And of course, I hate to say the obvious, which is, technology still continues to play out. The deals that are happening this week are proof that there's something going on out there. There's proof of life. We're still looking for great growth in that, generally in that sector. On the low end, you're talking about 9-10%. Year-over-year growth in EPS. On the upper end, with things like NVIDIA, you're talking about north of 50%, right? So those numbers, they're slower than they were, but they're still fantastic, and you can't ignore the opportunity there.
Gotcha. So if there's any kind of pullback in the short term here, where are you going to be looking? Will you sort of double down on those things that had looked a little bit rich?
Yeah, I mean, listen, correct, yes, we're definitely buying our conviction areas, right? Those we're always looking for buying opportunities. Those remain tech, communications. We're looking at some of the financials that we like. But in terms of themes, there are going to be some themes that will probably emerge. Look, we would like to get more involved in consumer discretionary. That's a little challenging, especially given a government shutdown, which could possibly affect discretionary.
Well, why do you want to get more involved in consumer discretionary?
Because the potential growth opportunities over there, and of course, it's not across the board, right? You have to be very selective over there. But these are things that should play out in a growth-friendly environment, right? So we think this will be this might be a tougher quarter in terms of earnings, but later in the year and the first part of next year, that's when you're going to want to sort of be in those things, especially when you have in a Fed rate cutting regime right now.
Mark, good to see you. Thanks for
coming. Great to see you as well.
Appreciate
Thank
it.
you.
And that does it for Morning Brief. We got much more ahead on Yahoo Finance. Opening bid is next.